Hello, good Saturday morning, and welcome to this weekend edition of the Short Vol Show Live. My name is David Lincoln, and I'm reporting to you from Cape Cod, Massachusetts, although the green screen has me in Chicago here on the picture. Welcome, and we're coming out of a week of heightened volatility with the market selling off. The sell-off continues. It's been almost a month straight of a sell-off for us in the markets. And, it's funny, the general public doesn't follow the markets all that closely. In fact, if you asked people on the street, which I do, people on the street being people at my side jobs, people don't really know, unless there's something that's really dramatic happening, people don't really know what's going on in the market. And if anything can be said about the recent sell-off, it has been an organized sell-off. Let's take a look here at the chart real quick, but it's just been this slow grind down throughout the month of May. And there are several people on Twitter that were commenting on this, and if I pull up my Twitter account here, maybe we can see some of them quickly. People talking about an organized sell-off. Not a whole lot of action as far as excitement, volatility low throughout this current sell-off, and it just sort of grinds lower, and it's worried me a lot. Like I worry, and I'm reminded of 2000 when I think of a market that just starts to grind and grind and grind lower. That's not a fun thing if it continues forever. However, there is opportunity here with the heightened volatility. Let's take a look at the VIX real quick here. We've noticed that we've gotten that pop. I did come out with a video on Friday, which I ended up taking down. And I just didn't really like the flow of it. Maybe it was actually Thursday. I guess it was Thursday. It kind of bugged me, the whole flow of it. I was like fumbling with screens, and it just didn't seem that smooth. And in that video, I made a couple recommendations for options, and I'm going to kind of reiterate those ideas because we're in a heightened volatility environment right now, and it's a good time to play in UVXY. I was noticing this guy on StockTwits, Sergey, who has been spot on with getting long UVXY and then selling it once it pops. Well, he was signaling that he was getting long it midweek, and then he was signaling that he sold his long position toward the end of the week. So this can be a good spot, a better spot than when we're in the basement in volatility to jump on to the short side. So I'm going to discuss a couple of options ideas, and I do want to discuss the recent tariff. Now, if we look at the E-mini chart, which I had up a second ago, you can see that this down move on Friday corresponded to new tariffs being announced by President Trump. And, I've always been anti-tariffs, and, whether, a Democrat's in office or a Republican, I was taught in my economic classes about free trade and about, the efficiencies of capitalism. You can only obtain them if you have free trade. And if you start blocking, free trade by taxing certain products, or, you're trying to support and hold up an industry in your country that's not doing so well against another country, that all is just not efficient for the economy, and it makes stuff cost more. And in the case with this tariff, what happened was the president said that there's going to be a 5% tariff, and then it's going to go up to 10% after a month, then to 15%, all the way up to 25% tariff on goods coming in from Mexico. And the reason for this tariff was because of migrants, according to the president. And it sounds like he's not talking about migrants coming into the U.S. It sounds like he's talking about migrants coming into Mexico from other countries. Now, the timing of this tariffs is tough because after NAFTA, the Trump administration was very proud of this new agreement that they were putting in place called the USMCA. And what this is a trade deal between the United States, Mexico, and Canada that was, according to this AP article, was hammered out in months of contentious negotiations as a replacement for the North American Free Trade Agreement, one of the Trump administration's most touted achievements. And they had finally, as part of the negotiation for this USMCA, they had negotiated lifting U.S. steel and aluminum tariffs against Mexico. Now, there is also a tomato tariff in place of 17% that had been in place for a while. And so this 5% comes on top of that for tomato growers. And there's been a lot of press about avocados being affected. They talk about millennials having their avocado spread, and that this is really going to upset them if the prices are higher. And I know that kind of pokes fun at this tariff, and you might say, oh, it's worth paying a couple extra cents to make America great again or something like that. And I can tell you, my dad is one of the biggest, if he could have a TV that only had Fox News on it and didn't go to any other channels, he'd be perfectly fine with that. And he actually brought up with me in a conversation. Usually we don't talk about politics, but he actually brought up with me in a conversation that he just doesn't get why these tariffs are being put against Mexico. Now, I do understand it. It is it's a thing to rally the base. It goes along with, and people like the concept of the administration is fighting back against illegal immigration. But this, doesn't make America great again, putting tariffs. What it does is it just makes stuff cost more for Americans in the long run. And, there's been studies and there's been debate on TV about whether, this isn't being passed along to the consumers. It's just the importers of fruit and vegetables are going to foot the bill, and they're just they're not going to pass it on to consumers. But if you really believe that, then I think you're a little naive. Of course, everything gets passed on to consumers in the end, and a tariff is like a tax, and it ultimately is going to hurt us. Now, but I'm not going to say that I'm not one of these people that's going to call the president names and this sort of thing. He is pursuing a rational political objective when he does this, and what the objective is to basically deliver on his promises to fight illegal immigration, and but it also serves politically for him. The president has more than our economy on his agenda. He's looking to get reelected, and he also has all these other people pulling at him, asking him to deliver for them, and so the other thing that he's got going on is that he needs to rally the base for the upcoming next election. And so this helps to do that, and it also helps to turn people and the media away from this impeachment stuff, and it gets people talking about something else. And the president's been very effective at keeping a lot of balls in the air so that he can control the narrative to some extent. But I don't want to get too much into politics. I want to stick to the fact that these tariffs are hurting not only the economy, but that ripples into the stock market. Now, we saw the market make a big down move when these tariffs were announced, but I want to caution you when you see the market move up, down, or sideways, and you see news stories that same day, the market is a very complex thing, and it's not necessarily that news story is what's driving the market. It can take weeks or months to figure out or to have a better picture of why the market is moving in a certain direction. I mean, the tariffs may not have come out that day and the market still might have been down just as much, or the market could have rallied and people would have said, the tariffs are a good thing, but the market could have rallied for some other reason. My point being that the market is a very complex thing, and to try to attach causal relationships to things, it might be the case or it might not be. So let's get back to volatility here, though. We see the VIX in an elevated state. Let's take a look at the VIX over the last year. Okay, so the VIX is the SIBO Volatility Index, and it is a measure of volatility based on a strip of options in the SPX. The SPX is the most traded product in the world, accounting for about 80% of trading activity is in the S&P 500, the SPX. And thus, a fear gauge that's based on a strip of options in that is representative of the volatility levels in the market. And if we look over the last, this is just a monthly view where we're sort of in the middle of the range, but if we look over a year, we are definitely not in the basement. And let me get out of the way here for a second. Okay, so this is a year view of the VIX, and you see us up around here about 1871, and you see we're kind of like right in the middle of the year, and this year has been a little bit more movement than we've seen recently in other years, but definitely we're off the basement bottom here. And when we talk about the VIX, and I've talked about this, so I'm not going to belabor it too much, but when we talk about the VIX oscillating up and down, that is not, of course, the story with VIX products, UVXY, TVIX, VXX. These products slowly move lower due to the state of contango and due to other factors, whereas the VIX just moves up and down and doesn't slowly move lower. It's just oscillating back and forth, up and down. So as we see, UVXY has come off of this 94 level and it got down to 30, now back up to 40. It will slide lower at some point, and certainly a better place to short than 30 is 40 up here. If we just kind of isolate the last couple months, you can see the down move, then a pop, the down move, then a big pop, the down move, and a pop. It's certainly reasonable to expect that this is going to have be followed by a down move at some point. Now, we don't know if it's going to pop to 46 before we get that down move, but definitely a tradable situation right here. And my contention is with it around 40 here to make a bet that it goes, let's say, below 39 or below 38. And if it doesn't happen right now, then just keep rolling that bet out until it does, because this will go below 38 again. It might be Monday, it might be Wednesday, it might be a month from now, but it's definitely going to continue lower as it has done in the past. UVXY continued. This 38 is an all-time low, and we expect it will go through another all-time low at some point soon. However, for that to happen, we need the market to turn around at some point. If we look at this, this is a 6-month chart of the market, and you can see after this high right around May 1st, we have just gone lower. It's been an organized sell-off, but we've just gone lower and lower and lower. So until this turns around, we're not going to see volatility get back down to like 13 again. But all it takes is like 2 or 3 days of sideways action, and volatility will definitely be lower than 1871. It's funny, I was listening to the Volatility Views program on Options Insider Radio, and they were guessing volatility. I didn't watch yesterday's program, but the program for the week before, the average guess for volatility was like in the 14s, and now we're way up here at 18s. Well, I was on the show a couple weeks ago, and I guess 16. I was the high end of the range, and it came in exactly 16 the next week. So I definitely got lucky with that guess, but I listened to the eagerly listened to the broadcast of Volatility Views the week after to confirm that I had won the crystal ball contest and got a bullseye guessing 16. It went out almost exactly at 16 that next Friday. So the host actually said I'm invited back on the show because I guessed volatility correctly for that next week. However, like I said, all the guys there were guessing, and these are apparent experts, were guessing volatility was going to be 14 on this Friday. Well, it's up at 18. So not inconceivable that it can be lower than 18 next week. All the experts were thinking it was going to be lower this week. So all that evidence allows me to move on to ways to short this market. Now, you can buy the VIX on the way up, or you can buy VIX products as volatility goes up, but I prefer to sell them on the way down just because I feel that there's edge in things like contango. Now, right now, the shape of the VIX term structure is very flat, and it actually favors the upside more than the downside, just the shape of it. However, it's not likely to stay there that long. If we look for a second at the term structure, we see that it is inverted in that the cash is above the futures right now, which it usually doesn't happen. The front 2-month futures are in contango right now, but the cash is above these futures. And so there is pressure for these. If everything were to stay like this, there would be pressure for these futures to move up towards spot. And in fact, if everything were to stay like this for long enough, you would see this front June future curl up to spot. What's been happening is everything's in flux, and so if you watch this trade over the course of Friday, the spot got up, it was up above 19 and then was moving all over the place. But this, as we look at this structure, you usually only see the structure with it inverted like this during a spike. And so the most likely thing that would happen right now would be for spot to move back down lower below, let's say, 18, and then the curve would be a more appropriate shape. If spot were to stay at these elevated levels, then you won't see the June-July relationship stay in contango like that. You will see June start to curve upwards to meet spot, which it inevitably needs to do before expiration. However, we're pretty far away from expiration right now in the VIX. If I pull up UVXY ProShares site and we look at the composition, daily holdings of UVXY, and let me get myself out of the way here for a second. If we pull up daily holdings of UVXY, we can see here that expiration is not until the 19th of June. So we've got a long time till expiration right now. That's when the front month future here expires. If you look at this chart, you're going to see this swap in here. Now, swaps can be something that they can just make a swap that says this swap mirrors what UVXY should be doing, or a swap can be just mirroring a future. It's not clear exactly what the swap does, other than I know that they're using it to save on capital costs. But if you look at the composition of these two futures, this ratio should correspond to the ratio of futures based on how far we are to expiration. And like I said, the next expiration is the 19th of June, so we've got a ways to go. That's why these futures right now don't feel compelled to race up to spot. The front month future, if we were really close to expiration, would be really close to spot. And actually, this chart is very flat. This, if we were in just a rallying market with normalcy, you would expect the front month future to be higher than spot for one thing, and higher by at least a point. Right now, they're close to each other and they're inverted. And so this kind of structure, like as I said before, we will see during a spike and during elevated VIX activity if the market either goes sideways or starts to rally look for spot to be a lot lower, below 18, say, and for this structure to line up more like the June-July structure is, moving upward away from spot. So what to do as far as options activity? My ideas have been to buy put spreads, and if we look at UVXY once again over the last month, we came from the $30 range. So pick your points. If you're looking 180 days out, you might go out all the way to, say, December, 200 days out, and I feel fairly confident that we will break through the all-time low before December. So you might pick something like the December 30-25 put, or 30-25 put spread. So you could buy the December 30 put, sell the December 25 put, and essentially it's lining up as this spread being the midpoint being about 250. It's a $5 spread, so 250 would mean that if you were to put the spread on, and contango works its magic, this will be below, probably far below 25 in December, and you would have doubled your money. Now, I know people are looking for fast returns, but doubling your money in 6 months is doing better than most successful Wall Street traders. So there's a trade for you to look at, the December 30-25 put vertical. It gives you plenty of time to be wrong, and but staying in contango. December's 202 days out. So if we take 202 and divide it by 30, we get 6.7 months. So let's say conservatively 6 months. If contango is around 5%, which could be a reasonable number for it over the last few months, that's sort of been where it's been around. So let's do 6 months times 5%. Let's see. I'm sorry. UVXY price right now 40 times 0.05%, 40 times 5% is $2 a month. $2 a month times 6 months is 12. So even if volatility stays at 18, with 5% contango, this would be trading $28 in 6 months. We've got 6.7 months, so more like $27, and that's with volatility at 18. Pretty unlikely vol stays at 18. Look for vol to go lower, and also we could go into higher contango. Now, what contango will be in between now and then is anyone's guess. If we pull up on VIX Central, we can look at what contango has been recently. So if I go to VIX Central here, I can pull up the contango tab. And this is going to show, we want to look at the F1, F2 contango because that's what affects all of our ETPs. And if I just isolate 2019, you can see that through most of for the first half, well, actually, for a lot of at the end of 2018, we were in negative territory, backwardation right there. But once you get to 2019, you see averaging, 5% or more for the whole year. So that's a reasonable assumption to make. All right, so for some other ideas, maybe you don't want to wait 6 months on a trade. Maybe you want to make a more near-term trade that vol is going to come back in sometime soon. So you could pick maybe the June or the 21 June, and you could just say, look, I think that it's either going to that stuff's going to go lower from here, but I want to build in a little cushion. So I might buy the June 42.40 put spread. So I can buy this put spread. If I pay $1.38 for it, it can be worth $2. All you need is in 20 days, UVXY is 40 or below. And right now we're in the middle of the spike, so good chance we're below 40. Good chance we're well below 40 in 20 days. However, there's some risk into this trade, of course. But a nice return if you pay $138 and the spread goes out at $2, a nice return in only 20 days. Maybe you want to be more cautious and you want to sell something like the 43.47 call spread. So you could sell the 43.47 call spread at around $1, and you collect that buck each time you put the spread on if UVXY is below 43 in 20 days. And the higher you move up with your strikes, the less the more likely the trade is to be a winner. If you want to get more aggressive and say, well, I think UVXY is going to go back to where it was, I think that this stuff's going to blow over a little bit, you can pick lower strikes. You can go out to maybe July and say, all right, let's buy the July 35.30 put spread. And I think that the smoke's going to clear. No one's going to think this stuff's that big of a deal. Maybe there's hints of a China agreement coming through. Maybe this tariff in Mexico, they decide not to do it, and I can more than double my money by July expiration by putting on the 35.30 put spread. And if we're back, all we need is for the situation to be back where it was a couple months ago, and this thing is going to go through 30 again. That's where it came from. It only took a couple weeks to get from 30. It can go back to 30 in a couple weeks, of course. And if that happens, you more than double your money if you put this July spread on. So that's another idea to look at as far as how to short volatility in UVXY. That's about real. Couldn't there be an interim reverse split? A reverse split, UVXY would need to get to. I think you're talking about December when you say there could be a reverse split. Yes, there could be a reverse split, but that wouldn't affect your trade. I mean, your trade, you're still going to get the original prices are going to stay what they were. So if this were to go all the way down, UVXY would have to go below, let's say, $8 for there to be a reverse split. So this December trade, if UVXY were to get to $8 before December, this would be such a huge winner that you could take it off for maximum profitability before UVXY even split. I really don't expect UVXY to have a reverse split this year. We would have to take out the highs in the market and have relatively calm sailing the rest of the year for this to get down to $8 and for it to reverse split this year. I know it's happened before in years, and certainly it's not completely out of the question, but once again, a reverse split would mean that this UVXY would have to go below $10 and stay there for a compelling amount of time, and maybe get below $8 before they would consider splitting it. So that would take a lot of contango and a lot of volatility crushage. I mean, you would need the VIX to get to 10 and stay there for this to reverse split before the end of the year. So I know looking in the past, it seems this has reverse split a couple times during a year. But first of all, that was when this was a 2 times leverage product. TVIX has a much better chance of reverse splitting anytime soon than UVXY, because when you delever a product from 2 times leverage to 1.5 times leverage, that really is going to take a lot of the bang out of it. And I think it would be extremely unlikely that we get a reverse split this year in UVXY. We would, a huge vol crush and staying in the 10 to 11 range in like max contango is what it would take for this to get to $10 this year. So I find that extremely unlikely that we would get a reverse split this year. However, like I said, if that did happen, your options get split and you still have the old prices on your bet. It's not like all of a sudden everything's reset and your options trades are way away from being winners. And when we do get closer to a split, I will go over with you some strategies, because when we do have a reverse split, you kind of want to get out of those option strikes before that time, because liquidity dries up. And it's probably not a huge issue for people who are watching this video who aren't huge traders, you would have ample time before a reverse split for that to happen. Usually when there's a split, people are talking about it for a while ahead of time, and it becomes obvious that that split is going to occur. My concern with shorting volatility is what I'm looking at when I'm thinking about shorting volatility and trying to decide what to do is I'm looking at these major indices, and if these keep grinding lower, let me move out of the way one more time here. If these indices keep grinding lower on us, it makes it difficult for vol to come in, just because the lower these things go, the more significant it is from a technical level, the more the public and politicians and others start to notice it, and the bigger of a problem this market becomes, the lower it goes. And volatility is going to stay elevated if this continues to move lower. Now, we can have a few days where it moves sideways to up, and that's all it really takes for vol to come back to 16 and for us to make money on these trades and be able to take them off. But as far as getting back to like a 10 to 12 range, we need to stop this down move in the market for that to happen. I mean, we can move it to a sideways move, but look, we're just grinding lower, and it's becoming more and more of a problem. And I can't tell you the exact reasons for that, and I can't tell you what will remedy that, but I can describe what is happening to you here with that down move. All right, I've gone longer than I wanted to already. I appreciate everybody watching, and good luck next week. We still have to wait another day until we can trade again on Monday. So, over the weekend, maybe look at some options, and so that you're ready with a game plan Monday morning. One thing that I've been looking at has been ACB. I'm happy that I took my ACB off position, that being one of the MJs. Let's pull that up quickly. It's really just gotten hammered. They did present at a conference on Friday, and I thought, well, maybe if they're presenting at the conference, that will at least stem the bleeding, but it really didn't. This can, from a technical point of view, can go a lot lower because it came from a lower spot. If we look back, it came from a lower spot. However, this will be a buy at some point, because it's a solid company, and the MJ industry continues to expand, and they're well positioned in their industry. So looking to scoop ACB at some point, but really all of these names are getting hammered. If we look at Tilray, continues its march lower. It seems like it's been in a death spiral ever since it hit 300. But this is a company that does make products, so it's not in a death spiral. But I'm being hyperbolic when I say that. Anyways, ACB looking to scoop some at some point here. Just all these names from the market. Look at Amazon. Just been getting hammered lately. If we look at Apple, it's the story of the market. Just Apple getting hammered lately. Now, Apple is another one that this is going to be a scoop somewhere. Apple, is a solid company. It's going down with the market, but this is going to be a buy somewhere, and it will turn around at some point, and you'll say, gosh darn it. I remember this last move up, I said, gosh darn it, why didn't I buy some Apple around 150? I probably used some more colorful language than that, but this will be a buy somewhere, and it's going to take people taking some risk and getting in and saying, this down move in the market is overdone. I'm going to buy some at some point. So look for bargain hunting at some point here, because this market will turn around again, and all these people will come out of the woodwork and say, oh, it was obvious that we should have bought it down there. Yeah, we definitely accumulated down there. These talking heads come on CNBC and pat themselves on the back that they were buying when everybody else was selling. Well, it can be hard to do that, and who knows what the point is that you want to buy. I mean, this could get worse, and it could go below where it went in December. Nobody knows exactly what's going to happen. But it is a tradable market, and I think with the volatility products, especially if you can discipline yourself to pick your points. If you're going to short it, you want to look for quick scalps. You want to look maybe, UVXY gets back to 37, you buy it back in. You don't necessarily need to go for the home run on these. And the same with the stocks. But, we need to stem this sell-off in the major indices. And, because that's the overall story to me. I know people have a political story they like to talk about, but to me, this is the story. We're off the highs and we're on this down move. And how long will this down move last? And can you kind of notice the signs as it turns around? I mean, this thing in December, look, it seemed like it was going straight down. It just popped straight back up. Now, when will this turn around and pop straight back up, or will it? It's hard to play. It's hard to call. But you should be focused on the major indices and what's going on with them. People look at other things like bonds and gold and whatnot, and I'll leave other channels to that. But the story of volatility is the story of the underlying index of the SPX. So keep that index in mind and on your screen as you trade. All right, thanks for watching today, folks. Please support me on Patreon. I am trying to get out to the StockTwits thing in September, so I can use your support on that as well. Stay tuned for more videos and exciting content. And please, if you're spending your Saturday looking at the stock market and researching stocks, get out there, do something fun. Get out in the sun. It's spring out, and get away from your computer. Live in the real world a little bit. Turn off your cell phone. Go outside, look at the sky, and enjoy your life. Thanks for watching, and I'll see you next time.